we're going to spend just a few more minutes. I don't want to get too deeply into this because we just don't have time. We've been going now almost 3 hours. But let's get through this concept, and then we'll pick up here next week. There are only two market profile, quote-unquote, market profile trades, the responsive trade and the initiative trade. And this is part of that market profile culture that had this special language, but this is so commonly used, and we use it. And this is pretty descriptive, so it's not as confusing as a lot of the market profile terms. The responsive trade basically is fading. It's taking in the time frame that you're executing. It's fading that immediate move. It's selling when the market's going up. It's buying when the market's going down. The initiative trade is a trade where you're going with the trend. But do you guys understand this? And I'm not being facetious when I say that. This can be initially confusing if you're new to what we're doing. Okay, it's responsive trade, selling higher highs, fading, buying lower lows. Now, you can have a responsive entry, and we do this a lot. And Troy and I talk about this a lot. Both of us like to take this trade, where you can identify a smaller degree balance area and a larger degree structure. And if you think the break, like this morning, all right, the trade out of or 2 days ago, the example we used, where you have that smaller degree balance area and you want to be long. Well, if you've got a minor balance area, a small degree balance area, you're actually fading if you buy the low of that smaller degree balance area. That's a responsive entry into what you're assuming is going to be an initiative situation. Now, the pure responsive trade is a trade where you have you think you're identifying a range, and you're selling the upper part of the range, and you're buying back the lower part of the range. Now, this, I strongly feel that you want to always try to get initiative trades, and that to just try to make a career out of taking responsive trades is not the way to go. Now, there are people that do that, and that's fine. I encourage you to please, I'm not saying not to trade responsibly, because I do. I want to make it perfectly clear. I do take pure responsive trades. As a matter of fact, when the market has been trending and trending and trending, like the stock market has been doing, quite frankly, on a day-to-day basis, your responsive trades have as much expectancy as your quote-unquote initiative trades because of the range of the day and the rotation of the market. But you only want to be taking responsive trades in the intraday time frame. You don't want to be fading the larger degree trend. If a market is moving strongly up and you get an entry, and then the market closes on its low, like this market did today, you at a minimum, you have to be taking partial profits, because you really don't have a signal that the trend has changed. And the odds are overwhelming in the case of the stock markets that at some point, I don't know if it's tomorrow, the next day, that one or more of these indices is going to take out or test the high that we made today. And even if it doesn't, you're going to get, from some lower level, you'll get a barn-burning rally that you can sell. So, and this is something else. A responsive entry should not involve fading a spike. There needs to be some evidence of a two-sided trade in some time frame before taking a position. Let me see if I can find a situation. Let me find gold. Gold is almost always good for that. Now, gold is one of these markets. Okay, this looks like a candidate here. All right, let's see. Let's go down to time frame here. All right, we were still in, what was the contract? Was it D-Scope? Was it the contract we just rolled from? No, it's FebGo, right? Where is it? Hold on a minute. Sorry, guys. Okay, here we go. All right, here's the spike, and this is a 30-minute chart. Now, if you didn't see this, you've got this spike here. So I'm not going to sell this on a 30-minute basis. Now, if I, and let me, all right, this is the 30-minute spike. All right, this is 5 minutes. You have a little bit of two-sided trading in here, but not a whole lot. The point of this is that most of the time you can go down in time frame. All right, here's 3 minutes. All right, this is a little bit better. And this is crude will do this too. I'll show you crude in a minute. We can probably find something crude. All right, this is a 30-minute spike. Now, this is a more tenable situation. If I'm going to fade this for some reason, because let's say the larger degree trend is down and I have this big spike up sort of into the ether, you don't want to just look at a 30-minute chart and fade this, because if you do, what will happen, eventually you'll have your head taken off. At least go down in time frame so you have some two-sided activity where you can reasonably say, all right, there's some, there's some selling coming in. The buyers are not running over everybody. I can sell this. It's an aggressive trade, put a stop above the high. That's what I mean by, in a responsive situation, don't, if you're fading, don't just fade pure spikes. Go down in time frame and identify some level of two-sided trade activity before you enter that trade. And Troy, I think you do this in currencies a lot too, don't you? Where you'll have a spike on a 30-minute basis and then you can go down, yeah. I mean, it happens in currencies quite a bit, doesn't it, Troy? Because you get some sort of news thing. Okay, your responsive trade, the ideal responsive trade is to wait for this second or third test. You don't want to be trading this or this. At a minimum, you want to be trading this or this. Because then, if I'm fading this, now if it's the first foray up to test this, then I've got to use a looser stop, because this may not be the absolute high of this balance area. So if I'm fading this in here, I can't just use a 1 or 2 tick stop above this. I've got to use a stop up here that's, I don't know, 6, 7 ticks in the ES. So if I'm taking a 6, 7 tick risk, then I better have, 15, 20 tick potential down to here. This is a higher probability trade. It's more defined, because then I can fine tune my risk, and I have additional, I have more evidence that this is indeed forming a balance area. So that's what I mean by the responsive trade. Don't necessarily use your first test of a high following a retracement as an excuse to fade the market. That's generally not a good idea. idea. There are enough trades, guys, in this that you don't have to force things, except the fact that for now, what you want to focus on is taking the best and the most conservative setups and the ones that you recognize, and especially the ones that you can afford. So that's your filter as you get used to this. And then over time, as things clear up and you get more comfortable and you just intuitively begin to see things before they're going to happen, then you can start to add, and you will naturally add. At this point in time, you're not expected to be able to trade everything that I'm showing you. There's plenty to trade if you'll let the quote-unquote more ideal situation set up before you take your trade or trades. You don't have to be an expert to trade this and to trade it effectively. But don't try to be an expert either by trading everything. Now, this is, I've covered this, but it bears reiterating. You know, if you get in a pattern like this and you see the market begin to form a balance, and it starts to sort of break its pattern that it's been in, and it's, you know, it's had this nice rotational deal going for a day or two or three or whatever it is, or in the case of an you know, intraday trade, maybe a couple hours or several 30-minute bars, or even a continuation trade on a 5-minute chart. A lot of times you'll begin to see the market begin to accept these higher prices up in here, and you know, you'll have a balance area that will form. You know, you'll have this, you know, you'll just have balance in here. And if you see this, then you got to really think twice about fading this move. And if you sold up in here, if you did fade it, then you might want to think about taking your trade off or tightening your stop or something. And this is an example of trading market condition, and it's an example of sort of trade management and trade identification using market condition, because you're looking at the market and you're saying, if then I'll do this. So if this market comes up here and it begins to form balance on top of this balance area, then the probabilities are beginning to shift that there's an initiative move beginning. And if it's an initiative move, I want to be going with it. I don't want to be fading this area. Okay, the initiative trade is a trend trade. And the target for the initiative trade relative to the risk of the initiative trade is greater than that for responsive trade. In other words, it is not unusual, and I'm not just saying this, and Troy's not just saying this. You know, some of the people in this room will validate this and attest to it. It is not unusual to have an initiative trade that will yield you 8, 9, 10, 12 times your risk. That's not a pipe dream. That's to be expected. Occasionally, not always, but if you don't try, if you're not focusing on trying to get to the initiative trade, you're never going to get a trade where you capture that outsized reward for the risk taken. And this is another reason you have to focus on occasionally catching the initiative trade, because it makes up for, it is your margin of error for everything else. The mistakes you make, the trades you get stopped out of, the trades you mismanage, all of which are things are always going to be a part of your trading to one degree or another. But the initiative trade where you make 10 or 12 or 13 or more times your initial risk more than make up for all that other stuff. And you don't have to have a lot of initiative trades, fortunately, for that to happen. Now, what will happen if you're taking initiative trades, you will have a lot of initiative trades that ultimately end up you're getting 2-to-1 or 3-to-1, or sometimes not even 2-to-1 because you moved your stop, and appropriately so, and the market did something funky and you got taken out. But you are going to catch the occasional huge reward trade if you will focus on getting in it. Just get in it and then manage it properly and see what happens, and you'll be pleasantly surprised. Now, there are two subcategories of initiative trade. There is the initiative trade that I just described that is taken in anticipation of the breakout from a balance area. And then the initiative trade is a trade taken once the trade has begun, but you're not on board. It's like the trades when I'm doing the BBSA, and I'll say, this market, we would favor short trades in this market against this conviction. We would favor, you've heard me say that now for weeks in the British pound and the Canadian dollar and some of these other markets. And if you're scratching your head going, Joel, that's not very helpful. Well, actually it is very helpful. Because it's telling you the bias of that market, and that the path of least resistance is down. And if you're trading those markets, and they're great markets to trade, then you've got to go down in time frame, and that's something else you'll hear me say in the DBSA, and find the setups on the smaller term charts. And Troy does a wonderful job every day of pointing out situations like that in the room.